Someone passes away. Their family finds a life insurance policy in a filing cabinet, makes a call, and then waits. What happens between that phone call and the money arriving in the bank? For most people, the answer is a mystery until they're living through it while grieving. Today, we lift the curtain on exactly how life insurance claims work, what causes delays, why some claims get contested, and what you can do right now to make sure your family's claim goes as smoothly as possible. This is Policywise. Insurance explained honestly. Let's walk through the process from the beginning. Step 1 is notification. Someone, usually the beneficiary or the representative, contacts the insurance company to notify them of the death and request a claim form. This can typically be done by phone, online, or through an agent. There's no strict time deadline to file in most jurisdictions, but earlier is better. Step 2 is documentation. The insurer needs proof, a certified death certificate, not a photocopy, a certified original, and a completed claim form. For larger claims or unusual circumstances, they may request additional documentation, medical records, the original policy documents, or identification for the beneficiary. Step 3 is the company's review.
The insurer verifies that the policy was active, the premiums were paid up to date, and that the cause of death doesn't fall into any exclusion. We'll talk about exclusions in a moment. Step 4. If everything checks out, the payout is approved. Depending on the jurisdiction and insurer, this can happen in as little as a week or two for a straightforward claim, or take considerably longer if there are complications. Here's the concept that surprises most people: the contestability period. In most life insurance policies, the first 1 to 2 years after the policy is issued is a window in which the insurer has the right to investigate a claim and potentially deny it if they find material misrepresentation on the original application. This doesn't mean the insurer is looking for excuses not to pay. The vast majority of claims, well over 95% industry-wide, are paid. But the contestability window exists because, statistically, people who are sick or plan to engage in dangerous activities have slightly elevated motivation to buy life insurance quickly. The contestability period is the insurer's audit window. If a death occurs within that first 2 years, the insurer will review the original application more carefully. If they find something material that was omitted, a health condition, a dangerous hobby, a history that wasn't disclosed, they can contest the claim. After the contestability window closes, the insurer can only deny a claim for fraud, a much higher standard to prove. Life insurance policies typically exclude certain causes of death from coverage. The specifics vary by policy and jurisdiction, so always read your own policy. But common exclusions include suicide in the first 1 to 2 years of the policy. After that window, most policies do cover suicide, though this varies by jurisdiction and policy type. Death while committing a crime. If the insured died in the act of committing a felony in many jurisdictions, benefits may be denied. Death from an undisclosed high-risk activity. If you didn't disclose skydiving or other extreme sports on the application and died doing that activity, coverage could be denied.
Fraud, as we covered in the mistake episode, intentional misrepresentation can void coverage. Some policies also exclude war, aviation other than commercial flights, or specific hazardous occupations. All the more reason to read the exclusion section of your policy, not just the summary. When a claim is approved, the beneficiary typically has options for how to receive the money. The most common is a lump sum, the full death benefit deposited in one payment. This is what most financial planners recommend because the beneficiary has full control and can invest or deploy the funds strategically. Other options include an annuity structure, regular payments over a period of years, which some insurers offer as an alternative. There are also interest-bearing accounts where the insurer holds the money and pays interest while the beneficiary draws from it. These can seem convenient, but they're worth scrutinizing. The interest rates are often modest, and in some cases the insurer earns a spread on the difference between what they pay you and what they earn on your money. For most people, the lump sum with a plan for how to use it is the cleanest outcome. Here's the actionable part, what you can do right now so your family isn't scrambling later. 1. Keep a copy of your policy somewhere accessible and tell your beneficiaries where it is. A filing cabinet is great. A fireproof box is better. Let at least one person know the insurer's name and policy number. 2. Keep your application information completely honest. We've said this before, but it bears repeating. Anything on that application that's found to be materially untrue is the insurer's strongest weapon for contesting a payout. 3. Update your beneficiary designations after major life events. A divorce, a remarriage, a death in the family, these all potentially change who you want receiving the benefit. 4. Keep your premium payments current. A lapsed policy doesn't pay. Set up autopay if possible. 5. If you have a financial advisor or attorney, make sure they know about the policy. Policies sometimes go unclaimed simply because no one knew they existed. This episode matters to everyone, but in different ways. If you're the policyholder, the most important thing you can do is prepare your beneficiaries. They shouldn't have to figure out claim procedures while grieving. If you're a beneficiary named on someone else's policy, know the insurer's name. Know roughly where the policy documents are. Know that you'll need a certified death certificate. If you're a new parent, this is the moment to double-check that your beneficiaries are updated, your premium is on autopay, and at least one trusted person knows where your policy is. If you're approaching retirement or are the adult child of aging parents, if your parents have life insurance, gently find out the basics. Unclaimed life insurance is a surprisingly common problem. Billions of dollars in benefits go unclaimed every year simply because families don't know a policy exists.
The life insurance claim process. Notify the insurer, provide documentation, including a certified death certificate, wait for the review and approval, choose your payout format. The two main things that delay or deny claims are the contestability window in the first 1 to 2 years and exclusions for fraud, undisclosed risks, or specific causes of death. To protect your family, be honest on your application, keep your policy information accessible, and make sure someone you trust knows where to find it. Next up, we go inside the financial mechanics of whole life insurance and follow the money. Where does your first year of premiums actually go? The answer will make your jaw drop a little, and it explains a lot about why these policies are sold so aggressively. That's next. Subscribe for one honest insurance breakdown every week. This is Policywise. General education only, not financial advice. Talk to a licensed professional before you buy.